And I'll also ask our presenter to turn his microphone on. Now, despite it saying Paul McEnroth, we don't have Paul McEnroth presenting today. We have Sean Jones from our Brisbane office presenting. We had a little technical issue with Sean's computer, so he's using Paul's, hence why it says he's Paul McEnroth. Sean joined the firm in 2019. He was admitted as a solicitor in 2017, and he works out of our Brisbane office. And Sean pretty much covers the field in terms of the work that he does for the firm. He works across all areas of work that the firm does. And he is making his debut today on our video webinars. So no pressure, of course, Sean. But I'm sure you're going to enjoy his presentation. Sean's going to be talking in terms of dealing with trusts and trust assets in estate planning. So without anything further, I'm going to hand over to Sean, who's going to be doing our presentation today.
Thank you, Adrian. All right, thanks everyone for joining us today. We're going to be talking about trusts in estate planning. So on the agenda today, we're firstly going to discuss what a trust actually is. Then we're going to look to the roles in a trust. And then we're going to compare some of the asset structures there as well to see the benefits of owning assets in a trust. Moving on from there, we're going to look at the different types of trusts. So see there the inter vivos trusts, which are living trusts created during the lifetime of a person. And then moving on to the testamentary trusts, followed by some family law considerations, in particular, the case of Cannon and Spry. So first of all, a common misconception amongst clients and even advisors is that a trust is a separate legal entity similar to a company or individual, which actually isn't the case. It is, in fact, a relationship between the trustee, the beneficiaries, and the trust property. Now, that relationship is established by someone called the settlor. And then, as such, the trustee is bound by what we call an equitable obligation to hold that trust fund on behalf of the beneficiaries. And because of that obligation, there are strict fiduciary duties imposed on the trustee, which you would normally find in the written trust deed. So moving on to some of the roles that we find in a discretionary trust. First of all, we looked to the discretionary trust because there are more roles found in that type of trust compared to others for reasons which we'll go into later. Starting off, we have the settlor who establishes the trust, and they have no further involvement there. That's because of a Section 102 in the 1936 Income Tax Act there, which has the potential to revoke a trust where a settlor has a benefit in it, which can have some pretty negative tax consequences there, which is the reason why when we're normally setting up trust deeds, you'll see that either the lawyer or the accountant is the one who's setting up the trust, and they're the one who just establishes it. And of course, to establish a trust, you need trust property, hence why we have a check normally for $10, and that establishes the trust. Then moving on next, we have the trustee. So the trustee is the person that has the legal title to all the assets of the trust. And then they, of course, manage the trust, running the day-to-day activities for the benefit of the beneficiaries. Then moving on to the beneficiaries, they obviously receive the benefit of the trust fund. And in the case of a discretionary trust, the beneficiaries only have what we call a right to be considered by the trustee, which is essentially a discretionary right. They have no interest in the assets of the trust or any right to the income. It is up to the trustee at the end of the day whether they get anything. And then finally, the ultimate control of a discretionary trust usually lies in a position we call either the principal, appointer, or sometimes the guardian. And this person can control, can appoint or remove the trustee or change the trustee. And sometimes they'll even have the power to consent to any trust variations as well. So as we can see there, you've got a diagram just explaining the basics of a trust. See the assets held by the trustee who has the legal ownership. And then, of course, the trust deed, which dictates the rules of the trust. We can see there the appointer and the principal controls that trust essentially because of the rights they have over the trustee. And then, of course, we have the beneficiaries at the end there who have the benefit of the trust. So it's very important when we're looking at setting up trust deeds for clients that we have accurate details of why exactly they want us to prepare a trust and what sort of trust they'd be after. It's critical at early stages there to know exactly what kind of trust we want to set up, who exactly is going to have control of that trust, who is ultimately going to benefit. And then looking forward, especially in estate planning circumstances, we want to see ultimately who the clients are looking to potentially pass on control or succession of that trust, usually their kids. So some of the aims we have when we're setting up trusts or structures generally, we look first to whether the clients are after limited liability or asset protection, or it could be both. How much control they want to have over an asset. CGT concessions as well. It's always important to have those where we can get them, namely the small business concessions and the 50% discount capital gain. And of course, the ability to split income. Now, when we talk about limited liability and asset protection, some advisors do confuse this as being one of the same thing when it's actually very different. So when we're talking about limited liability, we're talking about an entity or individual's exposure to debts or liabilities, as opposed to asset protection, where really we're dealing with the risk posed to an asset when an entity or an individual comes under attack. So looking first to the individual ownership of an asset, see there, dad's quite successful and he has an investment house. He owns that in his own name. And often we find that people that are just getting off the ground and starting to build up those assets, they often do have them in their own name. And that could just be due to poor planning or poor advice there. And as we can see, the result here is it's owned in their dad's own name. So there's no liability, no limited liability for him there. So if he had a loan out over that house, that loan is in his name. He owes the money. So at the end of the day, if that loan's called up, he's liable for it. And then of course, if the dad's sued, there's no asset protection at all for the house. However, he does have full ownership and control. And he does, of course, have access to the full CGT concessions available to him. And then lastly, of course, he isn't able to split the income. Any income derived from that investment house will be income of the dad. So the next sort of structure that we commonly see is company ownership. So here in the example, we've got mum and dad, they're shareholders in a company, and that company has purchased the investment property. So here we do have limited liability in respect to the mum and the dad. As shareholders, they are only liable to what they've paid up in for the shares. So at the end of the day, if the company's borrowed to acquire that house, then mum and dad as the shareholders aren't going to be liable for that company loan. But we don't have asset protection for that because mum and dad as shareholders have interests in that company. Then if mum or dad is ever made bankrupt, the trustee in bankruptcy can call up on the value of those shares, and potentially that puts the assets of the company at risk, particularly if the shareholder has a significant interest. But we do have full ownership and control of the assets through mum and dad's control of the company. However, we only have limited CGT concessions available under that kind of structure. We're not able to access the 50% capital gain discount, of course, given that it's a company that owns the asset. And finally, we can split the income according to the shares that mum and dad will hold. So let's say in this instance, they each held 50%. We can split the income 50-50, but there's not too much flexibility there. So then moving on to trust ownership of that asset. So we can see here we've actually got a company trustee. And the reason why we do that is because sometimes, or often the case is, the trustee may be taking on obligations or liabilities in managing that trust. So rather than having mum or dad as the individual trustee there taking on those obligations themselves on behalf of the trust, instead it would be ideal to have a company appointed that they would control. That way, we've just got that extra bit of protection with being the limited liability there for the parents. So that way, that company as trustee ever goes under, we're not placing mum and dad at risk of bankruptcy straight away. And then, of course, because we're owning the asset in a discretionary trust, the kids, mum and dad, only have a right to be considered. There's no right to the asset or the income of that house. So if mum, dad, or the kids ever wind up in trouble or made bankrupt, that house isn't going to be at risk. And then, of course, as a result of that asset protection, and because they don't have a right to that asset or the income of the trust, there's technically no asset ownership by any one of them. It's just owned by the trustee on behalf of the beneficiaries. Of course, we've got full control of the asset because mum and dad would be directors of that trustee company. And ideally, one or two of them would be appointers as well, so they can control the trustee. So at the end of the day, they're able to exercise control over that asset. We have the full CGT concessions available to us, both the discount capital gain and the small business concessions. And of course, we're able to be very flexible with that income. We have a wide range of beneficiaries there, and the trustee is at their discretion to decide who, if anyone, gets any income of the trust, or whether the house is transferred to any one of the beneficiaries. Okay, so we're now going to move on to different types of trusts, starting off, of course, with the discretionary trust as we referred to earlier. So as I alluded to before, trustee has the ultimate discretion here to distribute income or capital to the beneficiary. None of the beneficiaries have an interest in the trust asset. So that way, if any of the beneficiaries are declared bankrupt or come under attack, there's some left field claim. That way, if they do end up going bankrupt, there's no way that the trustee in bankruptcy can automatically break into that trust and get hold of those assets. However, having said that, one thing we commonly find with a lot of discretionary trust deeds is that they have default beneficiaries. Now, for those of you who are not aware, default beneficiaries are essentially beneficiaries that would be appointed in a discretionary trust deed. And what happens is where the trustee has not made a decision as to what they're doing with income by the end of the financial year, there would usually be a clause in there which says that the income is automatically to go to these default beneficiaries. Now, the reason why that's done commonly is because of to avoid the tax consequences, essentially, because if the trustee, of course, holds, if they're taken to accumulate the income at the end of the financial year, they're paying tax at the top marginal rate. Whereas if we've nominated default beneficiaries, they, of course, are paying less tax. However, at Cleary Hall, we take an entirely different view to this. We view that more important to have asset protection at the end of the day. There's a couple of problems that come from appointing default beneficiaries. The first is that sometimes you can just forget to make it, like trustee can just forget to make a decision by the end of the financial year. And as a result, we could have unforeseen tax consequences when a beneficiary is all of a sudden entitled to a portion of the income. And in a particular year, that could be fairly significant. And at the end of the day, that's going to lump that beneficiary with a fairly hefty tax bill. The other problem is over a number of years, if it's not noticed or it's ignored, we could eventually accumulate quite a substantial interest in favor of that beneficiary due to those clauses. So it could be forgotten about, and then one day that beneficiary comes under attack, is made bankrupt, and the trustee in bankruptcy comes in and sees that the default income clauses have slowly accumulated quite a substantial amount in favor of this beneficiary. And that can potentially threaten the whole trust and pose a real risk to the assets there. So for that reason, at Cleary Hall, we have fully discretionary trust deeds, which removes the default beneficiaries. We just accumulate the income in the event that the trustee doesn't make that decision by the end of the financial year. The way we see it, it's better to pay a bit more tax rather than pose a real risk to the trust assets. So moving on next, there is usually discretionary trusts and family trusts are considered one and the same. there is a slight distinction under tax treatment. So a discretionary trust can elect a family trust election, essentially, which is beneficial where the trust is looking to carry forward losses or flow through franked dividends. Of course, the only downside to that is that we do have to stick to a particular beneficiary to ensure that they maintain the family trust election. And that could be problematic where later on we're looking to potentially move out that beneficiary. So moving on next, we've got fixed trust. Now, fixed trust is the complete opposite of a discretionary trust. The beneficiaries under a fixed trust have a fixed entitlement to the assets or the income of the trust. So no asset protection is afforded to the trust assets, because at the end of the day, if one of the beneficiaries comes under attack, then the trustee in bankruptcy or creditors could just come in there and attack the trust assets based on that beneficiary's interest in them. So commonly we would see fixed trusts more in a business environment where we have multiple unrelated parties who are looking to be somewhat flexible, but they at the end of the day want fixed interest to ensure that they're entitled to the business, a portion of the income in the business that they're running, essentially. So we're going to look at a couple of types of fixed trusts. First of all, probably the most common type is a unit trust. So a unit trust doesn't actually have a set law or principle. It's established by subscribing units to unit holders who then pay a set price for those units into the trust, and that's what sets it up. Now, normally if those unit holders were individuals or companies, there wouldn't be any asset protection, because for the same reason, those unit holders are entitled to a percentage of that trust based on the units they hold. So there is a way around that sometimes. If we are looking to gain asset protection in a unit trust, say we have clients that are managing a unit trust, managing a business in a unit trust, and we're sort of concerned about risk posed to them personally if they own the units individually or in companies. Instead, we would own those units in discretionary trusts. So at the end of the day, if one of those owners was to be attacked by, be made bankrupt, then the whole trust wouldn't be at risk, because it's instead held on behalf of the discretionary trust, where it can't be said that any one beneficiary has an interest in those units. And then moving on next, we've got a hybrid unit trust, which is very similar to unit trust. The only difference really is that there is a category of discretionary beneficiaries available to distribute income if the unit holders consent to it. Otherwise, the income, the balance falls back on the unit holders, and it will be distributed in accordance with the units they hold. So this sort of model is more appropriate where we perhaps have unrelated families or owners in the business who are perhaps looking to be somewhat flexible with the income of the business, and they perhaps want to distribute some income in a particular year to relatives or family, gave some of the benefits of splitting the income there. So they would set up a unit trust and make that decision in a particular year to distribute income to those discretionary beneficiaries. And then we have special disability trusts, which are essentially set up entirely for someone who is severely disabled. So this is a trust that really is beneficial where we have family members who are wanting to contribute assets or funds in favour of the disabled person to care and accommodate for their future needs without impacting on their disability support pension. But of course, if we're looking to set up this kind of trust, there are a lot of strict requirements. These sort of trusts are managed by Centrelink, and accordingly, you should always make sure that they're being managed appropriately and and as they should be, because otherwise we could potentially put at risk the disabled person when it comes to their pension. Okay, so moving on next, we have testamentary trusts. So A testamentary trust is essentially a trust that's created under a will. So that would be one that's created basically after a person would die. So it's discretionary. A testamentary trust can either be fixed or discretionary. Doesn't have to be one or the other. At the end of the day, testamentary trust just means that it comes into existence once someone has passed away and it's created in their will. So if this was a discretionary testamentary trust, and usually they would be, it's not that common that you would ever see a fixed testamentary trust. So in that case, if it's discretionary, beneficiaries, again, don't have an interest in the income or the assets of the trust. So that way, if any of the beneficiaries come under attack or are made bankrupt, then those assets of the trust aren't going to be at risk. So there's no settlor in a testamentary trust. The person making the will and setting up the trust is essentially the settlor. They obviously have no interest in it because they're gone once that trust is set up. And then ideally, in some cases where we have particularly large estates or large families, we got a few children and they each have their own families, we can actually set up multiple testamentary trusts in favor of each one. And then, of course, this creates ongoing asset protection for not just the children of the testator, but their children and their children. So these testamentary trusts are ideal where we're dealing with clients that have significant estates, and the beneficiaries that they ultimately want to give these assets to could be minors, disabled, or professionals at risk of being sued, in which case we want to put them in an appropriate structure where they can continuously benefit from that asset protection. And then, of course, testamentary trusts have significant tax benefits, namely being that minors are taxed at adult rates rather than that higher penalty tax in a testamentary trust, as opposed to our normal discretionary trusts where they would be taxed at a higher rate. So that's particularly important where we have families where we want to continuously benefit not just the kids, but the grandkids as well. And we have a lot of minors. So moving on next. So this is a special trust that Clarior set up called Bloodline Testamentary Trust. Now, a Bloodline Testamentary Trust is a discretionary trust. So the same deal where we have beneficiaries that only have a right to be considered. There's no interest in the capital or income of the trust. The difference being with the Bloodline Trust is that we separate the beneficiaries into capital beneficiaries and income beneficiaries. And the capital beneficiaries are normally the bloodline, and the bloodline we can tailor to the client's needs. But typically it would be, in the case of a testator making a will, it would be their parents, their kids and grandkids and great-grandkids. And then, of course, we separate the income beneficiaries. These are normally the spouses and the in-laws. So the reason for creating this sort of trust is typically where we have parents that are a bit concerned about succession of their assets there, and perhaps there are children who don't have the best taste in their partners. So instead, we would set up this sort of trust to ensure that the assets pass down to the children and their children, and only the spouses can benefit from the income and not have access to the assets, essentially. So as you can see there, as an example, Mum's had a very large estate and she's set up 3 Bloodline Testamentary trusts in her will. See there, Dad's the survivor and he's the trustee, along with each of the children, managing their own bloodline trust on behalf of their own family. See there, it's pretty comprehensive. So the assets, like I mentioned before, are protected from individuals' risks. And of course, at the end of the day, the in-laws and the spouses can still benefit from the income derived from those assets. So just a quick summary here. We look at the level of asset protection offered under each trust. So of course, Bloodline Trust offering the highest level of protection, Discretionary the next, and then of course just a little asterisk there next to the unit trust and the hybrid unit trust. So again, as I mentioned before, if the units were held just by individuals or companies, then that's a very low level of asset protection. At the end of the day, those assets are at risk if those unit holders are attacked. Whereas if we make those unit holders discretionary trusts, then that's going to give us a high level of asset protection, because it can't be said that any single beneficiary of that discretionary trust has a right to those units in the unit trust or the hybrid unit trust. So just looking to some frequently asked questions we have when it comes to setting up these structures and trusts. Now, commonly there will be loan accounts that clients have when they're managing partnerships, companies, or trusts. This could be either from the entity to them or from them back to the entity. Now, what normally happens is there are either loans made or just recorded just because the individual's just keeping the business going, or vice versa. There's an amount of income derived that year that we've just set aside for that beneficiary, but we haven't actually distributed to them. Now, it's often forgotten about and hidden away, and it's something that we constantly come across when we're looking at estate planning. So these loan accounts or distribution accounts, they represent a real asset there that can be called up at any time. So that's something to really keep in mind where there's a particular beneficiary, again, that comes under threat, or even if a particular beneficiary is entitled to a fairly large loan account or distribution account, and upon their death, they could just be distributing their estate equally amongst the children and their testamentary trusts, when really there was a particular, we wanted to pass the succession of that partnership, company, or trust to a particular child. And instead, because of these loan accounts being distributed amongst all the beneficiaries, there's a real risk there that that's going to threaten the actual entity and the succession of that entity down to the child that we wanted to benefit from that and continue to run. So as always, we would prefer to deal with them now or in the will to make sure that ultimately that is either forgiven or ideally can be gifted to the child that we want to ultimately benefit from that entity. So just continuing on further frequently asked questions. We've also got a common question is, how do we go about removing a trustee if one comes under threat, or maybe we just want to change one over to a more suitable trustee there. So in discretionary trusts, that of course would lie with the principal or the appointer. And in unit trusts, there's no principal or appointer, so instead the unit holders have to consent to the appointment of a new trustee. And then finally, we move on to, can a discretionary trust be used as a safe harbor from a potential divorce? The short answer to that one is no, and we will go into why that's a real risk there. In particular, it's a common question that's come up for me recently in the past month. So we'll go into a key case there explaining why that's an issue. So moving on to family law considerations now. There was a case came out and it was held in 2008. So it has been around for a few years now. But nonetheless, it's still an issue that is constantly coming up. Like I said, I've had clients a few times this month approach me with this very issue, asking me if they can set up a discretionary trust for the purpose of shifting assets away from a current partner. And since this case, the short answer to that is no, it's not going to work. So before this case was decided, the trust assets of a particular person in a relationship, or if one of the married couple held a trust and that held significant assets, then that trust would be taken into account as a financial resource. And what that means is, at the end of the day, it wouldn't be part of the property to the marriage before this case was decided. Instead, when we're looking at how we're going to divide the property to the marriage, they would take account of the of one of the couple's interests in that trust, and that may result in them receiving a lesser share of the property to the marriage. So since this case was decided, there's now a real risk that where the trust is essentially the alter ego of the relevant spouse, those trust assets aren't just going to be taken into account as a financial resource. They're actually going to be pulled into that property pool and divvied up there. So that really breaks up the trust essentially. So to go into a bit of the background of what this case was, essentially Dr. Spry, who was a prominent tax barrister, and his wife, he established the trust in 1968, and himself and his wife were beneficiaries of that trust. So in 1983, Dr. Spry excluded himself as a beneficiary. And then further on down the line, you can see in 1998 there, started to have difficulties there in his marriage to his wife. So he's gone ahead and varied the trust to exclude his wife as a beneficiary as well. Then what's eventually happened is that himself and his wife were divorced in 2001. And just shortly after that time, what Dr. Spry has done is he's essentially applied that trust fund into 4 new trusts for each of his children, and later appointed Mr. Cannon as a co-trustee of each new trust. So essentially you can see here, he's really trying to separate himself and his wife from any interest in the trust, and then of course put it in favor of his children and appoint a co-trustee to try and distance himself and his wife as far as they can. Fortunately, that didn't work for him. So the majority of judges in this case said that essentially due to Dr. Spry's interest as trustee, coupled with his power to appoint trust assets to himself and his wife, that fell within the definition of property of the parties to the marriage within Section 79 of the Family Law Act. Now, it is important to distinguish there that the judges have noted that there is a broader definition of that in the Family Law Act as opposed to the sections you would see dealing with property in the Bankruptcy Act, which is why you wouldn't see the same issues coming up when the trustee in bankruptcy steps in and looks to, or is just looking around to see if they can break into the trust at all. They couldn't rely on this same definition because there's a distinction there with family law, and there's a much broader definition. So there's a real risk there that those assets will be split up. Now, minority 2 judges in that judgment also said that the right that the wife had to the due administration of the trust and the right to be considered, they considered that to be property of the parties to the marriage, which is quite a far-reaching view. Like, at the end of the day, it was a minority view, but nonetheless, it is something to keep in mind because, as always, dissenting views could be taken into account in the future and applied more broadly. So some suggestions we have here when we're dealing with these sort of issues is just to do as best we can to ensure that that trust is not the alter ego of the relevant spouse. Now, at the end of the day, it's not just about setting up an appropriate trust, or trying to set up one where from the very outset, the spouse wouldn't be a beneficiary. It's going to come down to who has control of that trust. So we ideally want to be appointing unrelated parties, which is why we normally suggest an accountant or lawyer as well to be appointed as a co-trustee. Potentially, we just want to exclude both the relevant spouses from any benefits from that. And really where a lot of this comes into play is the trust ought to be set up before the marriage. Quite frankly, if the trust is going to be set up during the marriage and it's going to be accumulating marriage assets, then it's a very high probability that that trust is going to be split up. And then, of course, it got down the end, also consider our bloodline trusts. But again, those bloodline trusts are very effective where we have parents setting them up on behalf of children, just because there's that degree of separation there. The children are inheriting succession of that. You would normally have unrelated parties appointed as co-trustee as well. There are a lot of steps taken to just distance ourselves as far as we can from that trust being considered the alter ego of the relevant child. So again there, just to recap, we don't want to accumulate any assets during the marriage in a premarital trust. that's going to put the premarital trust at high risk there. Ideally, if we have a client that already has a trust, whether they set that up themselves quite some time ago or inherited the succession of it, we don't want them to use that and accumulate assets during their marriage or their relationship, because that is going to pose a risk to the trust. All right, that does it. Does anyone have any questions?
Thanks, Sean. While we wait for anybody to type in some questions, just a reminder that you will receive a feedback email later today at about 12 o'clock, actually. We really appreciate it if you could take the time to complete that. I think we can all agree that Sean did an excellent job during the presentation. It's not an easy task, and I think he did it well. Our next session will be in 2 weeks' time. It will be continuing on the estate planning theme, and it will be on dealing with non-will assets. So keep an eye out for the invitation to that when it comes out. Just a point on that, it will be on Thursday rather than our usual Friday, so Thursday the 13th, because Friday the 14th is a public holiday in Queensland, and our presenter will be from the Brisbane office. I'm going to stop recording now, and Sean and I will stay on the line to see if anybody has any queries.